HMRC Christmas tax rules often surprise side hustlers each December. Here's what counts, what doesn't, and when to register. Stay compliant and keep more of your Christmas earnings. Many crafters and artisans assume December profits are too small to matter, but HMRC Christmas tax rules say otherwise, and the details surface just when market stalls get busy and cash boxes fill up. The principle is simple. If total trading income across the tax year tops £1,000, it's time to register as a sole trader, file a return, and plan for the bill. Even if the work feels seasonal and casual, most people selling handmade gifts, cards, or upcycled finds are running a trading activity rather than clearing clutter, and that distinction drives taxable income. Selling old personal belongings rarely needs reporting, but the moment someone makes items to sell for profit, they step into the territory covered by HMRC guidance. That's where records of costs, dates, and revenue stop being optional and start being essential. The £1,000 trading allowance sounds generous until everything is added up, and many underestimate how quickly Christmas earnings stack up when markets, pop-ups, and online orders overlap. A person might make £600 at fairs and another £500 via sponsored blog posts. Together, they exceed the tax thresholds and must register, file, and pay on time. The smarter move is to track all sources from day one, not just in December. Online platforms now feed data to HMRC, which means marketplace sales leave a digital trail whether the seller notices or not. Those who notch up frequent sales and receive payments approaching the figures platforms flag should assume visibility and behave accordingly. It's less about fear and more about predictability. Clean records reduce stress when the self-assessment window opens. The deadline dance is predictable too. Earnings in the 2024-25 tax year get reported by the 31st of January 2026, so early planning beats last-minute scrambles. Keeping receipts for materials, stall fees, packaging, and postage not only supports compliance, but also trims taxable income when claimed properly. And don't forget business mileage too, as traveling to and from venues to sell your wares can mean a reduced tax bill. There's no virtue in overpaying because your records were sloppy or assumptions fuzzy. It helps to separate decluttering from trading with a clear mental model, because the tax outcomes diverge. Selling a single personal item or collection for more than £6,000 can trigger a report, even if it's not trading, while routine craft sales at lower price points can still be a side hustle that is squarely within the scope of HMRC's rules. The difference lies in intention and repetition, not the season's sparkle. Sellers who want to reduce risk should use the official tools, starting with the HMRC Checker and the Help for Hustles portal. The language is plain enough to map activities against obligations, and the calculators make quick work of estimates. When the numbers inch toward the allowance, it's time to register, rather than hope the festive rush goes unnoticed. Small ventures don't need to be complicated, but they do need to be deliberate. By following HMRC guidance, tracking every sale, and understanding how tax thresholds operate, creators can enjoy the markets without dreading the paperwork. In short, HMRC Christmas tax rules are not a trap for the unwary. They are a framework to keep a joyful side hustle sustainable. If anything I've written in my blog post resonates with you and you'd like to discover more of my thoughts about Christmas hustlers and whether you need to pay tax, then do feel free to call me on 07434 287603 and let's see how I can help you.